Heico Corporation just soundly beat Wall Street consensus on both the top and bottom lines for Q3 of fiscal 2026. Revenue hit a record $1.41 billion, which clears the $1.35 billion estimate. And, well, diluted EPS came in at $1.67.
Yeah, that blew right past the $1.51 expectation.
Exactly. And management's qualitative guidance was highly favorable, projecting continued net sales growth and strong cash flow for the remainder of the year. The market obviously loved the print. The stock popped 2.41% to $359.50 in after-hours trading.
Right, and then it wrote a 3% pre-market bump the very next day as the buy side digested all those numbers.
So today we are taking HEICO's Q3 report, analyst notes, and aerospace supply chain data to figure out our mission for you in this deep dive. Is this buy and build compounder an unstoppable machine? Or is its 60x valuation a house of cards?
Well, to answer that, we really have to look at the mechanics driving those top-line beats, starting with their flight support group.
We had the FSG.
Yeah. They pulled in $947.8 million in sales, which is an 18% increase, while expanding their operating margin to 25.9%. And this isn't just about selling more parts, it's about the specific type of parts they sell.
And we're talking about PMA, right? Parts Manufacturer Approval Components. If you're an airline bleeding cash right now, HEIQ is essentially offering you generic prescription drugs for your fleet.
That's a great way to put it, actually.
They basically take a specific, highly used airplane part, reverse engineer it, prove to the FAA that it's identical to the original manufacturer's part, and then sell it to airlines at a 30% discount.
And when you look at the mechanism there, that 18% growth makes perfect sense. I mean, airlines are getting squeezed by incredibly high operating costs right now.
Oh, absolutely. Across the board.
Yeah, so a 30% discount on routine maintenance parts, it's irresistible. It's driving massive adoption away from the traditional OEMs.
But that structural advantage in flight support, it doesn't entirely explain the massive cash pile we're seeing across the whole company. For that, we really have to look at the tech side of the house.
The Electronic Technologies Group.
Exactly. ETG just posted a 36% sales surge, hitting $483.5 million.
And they did that while bouncing back to a really robust 26% margin. That specific number is a huge relief for analysts.
Because of what happened in Q1?
Right. Back in Q1, we saw margin contraction in this segment that really spooked a lot of investors. But this quarter proves that the Q1 dip was just a temporary shipping glitch. It wasn't some structural deterioration.
So they're charging a premium and the market is just paying it.
Exactly.
And those strong segment margins translated directly into a 49% jump in operating cash flow. That gives them $345.3 million for the quarter.
Which is a lot of dry powder.
It is. And they're taking that cash and funneling it right back into management's aggressive M&A strategy. I mean, they just issued $1.2 billion in senior notes to clear out their revolving credit facility.
Yeah, which keeps their net debt to EBITDA at a very healthy 1.57x. It's the classic buy and build playbook.
Let me push back on this, though. You look at HEICO's, and the stock is trading at a steep 60 times trailing earnings. Plus, they're sitting on $2.54 billion in long-term debt. Isn't this priced for absolute perfection?
I mean, yeah, that is the core vulnerability here.
Right, because if they stumble even a little integrating these acquisitions, doesn't that premium start looking incredibly fragile?
It absolutely does. Because of the leverage from this M&A spree, their quarterly interest expenses are actually up 13.3%. So that puts immense execution pressure on their newly acquired assets.
They have to perform immediately.
Right. They can't afford any integration hiccups when they're paying that much just to service the debt.
And underneath that financial pressure, there's this really ironic operational bottleneck threatening their growth.
Yeah, the repair stations. HEICO's own component repair stations are facing massive backlogs right now. And why? Because they literally can't get the raw materials they need from the exact same OEMs they compete against.
Wait, really? The ones they compete against in the aftermarket?
Exactly. They're profiting off the broader aerospace supply chain chaos, but their repair stations are also falling victim to it.
Wow. Which leaves you with a really fascinating dynamic to watch as an investor. I mean, AIO is currently thriving because airlines are flocking to their cheaper alternative parts while the OEMs struggle to deliver.
Right.
But if those OEM shortages suddenly resolve, will Heico's own repair station backlogs become the anchor that sinks their premium valuation?
That's the multi-billion-dollar question, honestly. It all comes down to how management executes over these next few quarters.
Definitely something we'll be tracking. Make sure you follow the show for your daily earnings coverage, and we'll catch you next time.